Good afternoon or good morning, depending which side of the country you're joining us from. Thank you for joining us today. Super excited to talk about employee benefit pre-funding accounts and charitable donation accounts. Great to be here, and thank you for joining us this post-Labor Day time. As we go to the next page, I'm Charlie McQueen, President of McQueen Financial. Excited to be here with representatives of actually one of our three major areas, but we have our investment advisory team, which we're going to be talking with two of the components of our investment advisory team. We also have our asset liability management team, which includes our CECL group, and our valuation team, which includes mortgage servicing rights and transaction advisory. So I'm thrilled to be here to represent all three groups of our organization. Today, specifically on the next slide, I want to thank both Craig Cecilia, our Chief Investment Officer. Craig oversees all of our portfolios and activities in the portfolio area. And then we have Zach Whaley. Zach Whaley comes and joins us here. Zach is responsible for alternative portfolios here. We're going to talk a lot about those. So Zach, great history, great experience. Appreciate you joining us. And Craig, thank you for joining us also with your great history and experience and knowledge today.
You betcha. Thanks for having us.
It's great to be here, Charlie. Thank you.
You're welcome. You guys are really good at what you do, which makes this really easy for me and limited for me today. So I'm excited. I get to sit back and enjoy the ride. And speaking of that, a little housekeeping on the next slide. A couple things to talk about here. If you have any questions, click on the Q&A button. It's a little question mark. It says Q&A. It's either on the bottom of your screen, top of your screen somewhere, depending which version of Zoom you have. So feel free to ask a question. I will pose it to the panelists during the presentation if it's appropriate, or at the end. Also, today's webinar is being recorded. You please reach out to your McQueen Financial Advisor, your MFA advisor, and they will happily send you a copy. You can also visit our YouTube channel. And our YouTube channel will have this, all of our past webinars, actually really exciting. And also this webinar will be uploaded there shortly. So on the next slide, Zach.
And Charlie, I just real quick, I told my daughter I was going to be on YouTube today and she didn't believe me. So there's the proof right there. Yeah, very excited.
It is exciting. You know, obviously you can figure out the age of Zach's kids and my child, my daughter. I told her I was a YouTube star and she said it didn't count because it was work related.
Touche. She isn't wrong.
So, well, we got a whole bunch of stuff to do here. We're going to kick off with an economic update, and we're going to get into our different accounts and our pre-funding accounts, some opportunities, great time to buy in, and uses of liquidity, a whole list of things here. So I'm really excited with that. So I'm going to hand this off to Zach and Craig to go through the agenda here a little bit more if you guys want, and then hop into the economic update.
Excellent. Thank you, Charlie. Zach, we're going to take it away from here. Just to go through an overview of the agenda for today, we'll start off with a brief economic update. Everybody likes to hear about that. And then we'll go into some detailed conversation about employee benefit pre-funding and segue into some charitable donation accounts. Or Zach, I might have those flip-flopped. We might be doing CDAs first and then employee benefits. Is that right?
We're going to describe them both, but we're going to actually do some samples with the EBPA first. So we have it in the right order.
Hey, perfect. All right. We're batting 1,000 then. And then talk about, the opportunities to make more money and why we like these. And then answer some questions throughout the presentation about, why we doing something now with the uncertainty of the markets as well. And what we are looking at with respect to liquidity, because liquidity is an issue for some right now. And then why not to wait, and go into some Q&As at the end as well. So let's get started.
All right. So first up, we're going to talk about the economy. Craig, you want to fill us in what's been going on with the stock market?
Sure. I'll give it a go. Sounds good. We're starting off just to talk briefly with the stock market. It's we're looking at two of them. One is the S&P, and you can see we've had a little bit of, and I don't want to use the word correction, so I'll say a little bit of road bump in all of the markets, whether you're looking at large or small. They're kind of moving in unison. But ultimately, if you kind of look back, and it's really hard on my screen, one, because I got terrible eyes, but if you look back, even just simple as, like 4 years ago, we're still kind of ahead of the game, right? And the question now is are we going to continue to go down? Are we going to go sideways? Or, is there room to go down? Or can we just expect to have those awesome returns that we had, going from 2020 to 22? What's your crystal ball say, Zach? A little adjustment or flat or going up?
Well, I think more adjustment might make sense. I know we have fun arguing about this, right? I can be a little more on the conservative side, or dare say bearish side. But I think that we've got a little bit more room to just kind of go back down to be in line with the trend we've been traveling in for the last decade. So it's not a dramatic move down, but it's an opportunity. If we move down, there's an opportunity there.
Yeah, absolutely. Especially in the types of portfolios that we're managing and the dividend stocks that we look at, it's not necessarily a bad thing, because we do see a little opportunity for just a little bit of adjustment down is the theme there, of not any kind of major correction from here. And if we look to the next page, the chart here on the S&P is very much similar to the NASDAQ as well. And it's really important to look at these. We know that there is a little bit of an economic slowdown or feeling going on in the stock market is reflecting that. And so that's why was one thing that we here are constantly looking at, because we do have a good amount of exposure to the stock market through our both alternatives and charitable donation accounts. All right, so one of the biggest things that everybody looks at in order to find out if we're going to, experiencing the R word is our GDP. How is our economy expanding? And we had a 1.6 decline in the first quarter, a 0.6 decline in the second quarter, so a couple consecutive declines. A lot of variables went into why there was the decline, and I want to make sure one thing I do point out is the value of the dollar. We look at that, and we looked, even if we look at the fourth quarter of 2020, the value of a dollar and the amount of imports that are coming in versus exporting has a big impact on our GDP. But a lot of people do kind of have in their pocketbook of a rule of thumb, if we have 2 consecutive negative quarters, we have what they call as a recession. I expect that we are going to get a defined definition by the Bureau and the committee, and we can't argue that things are slowing down a little bit. I kind of look at some numbers that came out even just as recently as just this past Friday, and we'll talk about them, some payrolls, some factory orders, some capital good orders. But ultimately, we want to make sure that we kind of don't continue to decline on this GDP, because we want to make sure that we can kind of retrench into having a growing and expanding economy. Unfortunately, we're going to be in a little bit of a cycle of a slowdown that we're experiencing now until we turn the corner later on in 2023.
So our favorite topic, Craig.
Yeah, the yield curve, right? Everybody, if you're listening right now, you should really pay attention to what this yield curve is saying, because the Treasury curve is very telling of not only what's happening now, but what they're expecting to happen over the next 12 months. And a flat to inverted yield curve is not necessarily good for the outlook for an economy. And you can see here as we go across just the top row of the chart on the bottom, where we were back in 12. We had the 2-year at 25 basis points, the 10-year at 170, and overnight rates were just basically zero, if you will. And now, wow, what a big change. Overnights came up almost 300 basis points, and pretty darn quickly. The 2 years come up 325 basis points, and the 10 years only come up 163 basis points. So that's where you can see that has deliberately caused that flattening of the yield curve. Got to remember, I'm not doing it to myself, so I'll go this way for left to right for you guys. And ultimately, the inverted yield curve is a signal that, hey, we are actually entering into an economic period where we expect a little bit of slowdown to take place. The Fed has been raising rates. You can see that overnight rates have gone up a couple hundred, 250 basis points, or 225 basis points. And the mid and the long term has come up, yes, but it has not gone up with the steepness or as much. And so it's basically saying, we understand you're slowing down inflation, right? That's a big problem right now is inflation. But we're not so certain that the economy is going to continue on with these higher elevated rates. So they do expect a slowdown. The two mandates that the Fed has, and that's this perfect chart here, the two mandates that the Fed still has is full employment, which we do have and we continue to have, but also is that making sure that we have price stability. And that's the big conundrum that they're in right now is gosh, we have one, but not the other, but we're slowing down the economy by raising rates. It's a must. So looking at where we are here on the right side of the curve, this is a historical spread between Fed funds, the 2-year Treasury, and the 10-year Treasury. 3 very key rates across the Treasury curve. And on the right-hand side is where we are today. And you can see that the 2-year is at a 350. It's higher than both the Fed funds as well as the Treasury. And as you kind of look at the relationship to all these, where we are right now versus some other very key points, if we look where the cursor is, say in 2018, 2019, as we let up, you can see that 2-year Treasury slowly came up to where the Fed funds and 10-year Treasury was until we got to an inversion, right? Fed funds were, as we were coming down, Fed funds was higher, and we went into more of a recessionary. And actually, it's a very unique time when we had the recession as a result of the pandemic. But if we also look back, say, to the Great Recession, and the time frame from 2005 through 2008 or 2009, the relationship is very telling of what type of economic environment we are in. And you can see the Fed funds, that inverted spread, the 2s and 10s. And what we're expecting now is to get very similar. Now, if you look back to where we are today, the Fed funds rate, if the Fed continues to raise, which the markets do expect them to raise, we may get back to that inverted stage, which is actually going to continue to slow up the economy and economic expansion that we really need to continue to have. So crude oil, it's our friend and it's our enemy. We're right now, we've had a little bit of a drop off today. I think we're right around 84. We're as high as 120 recently, and it's come down. It really does impact every part of our economy. When oil is expensive, it slows down a lot of things, with one exception is, the refinery world, exploration, transport, refinery, which employs a lot of people, but it can get too expensive to where it slows down transportation for goods, which gets passed right on down to consumers, to creation of goods. There's a lot of plastics, there's a lot of oil in plastics. So we have to also think about the cost for oil, not only to transportation, for commerce, for pleasure, but we also have to think about it into simple manufacturing of goods as well. So we really need to have that come down a little bit more and go sideways. We do have the war going on, which is impacting European supplies of oil as well. So we've got a lot of different things that are really impacting this right now. We hope that it continues to stabilize and go sideways, maybe you settle in somewhere around that long-term average of $75 a barrel or somewhere in that range. That'd be great for our economy.
My Kroger fuel points are softening the blow right now, Craig. I don't know if you utilize those.
Hey,
highly
nicely
recommend.
Done. Nicely
highly recommend.
We do, and different Shell stations do have different discounts based on location and regions, which is interesting. Seems like there'll be a lawsuit somewhere down the line for somebody.
There you go. Unpaid advertisement, by the way. Don't get the wrong idea.
I love it. So looking at delinquencies. So one thing as we talk about, we're all financial institutions on this call, and we always look at risk. right? Whether it's interest rate risk, credit risk, but as we do look at our balance sheets, we always want to make sure that we look at a trend, because trends can start and they can fade, or trends can stay and stay on path. And right now, it's really hard to find anybody that has asset quality problems. It's one of the big debates that we're going through as we implement and have brought on all the CECL calculations, right? Future expectations, current, historical. But one thing you kind of do look on the right-hand side is a little bit of uptake on delinquencies. And when going into or starting a recession, we typically don't have a lot of delinquencies. It's, halfway through is when we start to see the big numbers. And you can kind of see back in 2008 to 2010, as we started the delinquency started predetermination of the recession. And then when they defined the recessionary period, you can see it continue to rise throughout there. So we want to be very vigilant. We want to make sure that we do properly use forecasted, expectations on delinquencies when doing our CECL numbers. Some of the early warnings that we are seeing is in large office real estate. There are some delinquencies going on there. Lower credit car loans also starting to see delinquency upticks. And I think it was in this morning's Wall Street Journal that we saw, junk loan defaults. They're starting to trigger as well. So we are seeing the worm change a little bit. And I know that there's markets and regions that get a little bit of sheltered or have a delayed effect, meaning big metropolitans hit it first and then it slowly trickles off into different regions. So this is great for planning, especially for this time of year as we go into the budgeting season. Make sure we keep an eye on this because we're a little bit concerned that delinquencies will start to trend up a little bit more.
And speaking of car loans, let's take a look at the auto industry, Craig.
Yeah, look, this is just interesting and unfortunately a bad chart here, because what we got to look at here is annualized car sales, and we are not where the market really wants them to be, and we could definitely use some more. We just had some announcement from Ford laying off a few thousand people, and we're starting to see it be impacted into all of the OEMs as well. There's a little bit of a trickle starting to happen here. But ultimately, the other thing that we did look at is used car prices. We've seeing the latest data, they are no longer increasing as much as they did. And actually, we've seen a tiny little downturn. And you can say, oh my gosh, it's a terrible downturn. It's a surge or drop in prices, but because we haven't seen us drop in such a long time. But we are kind of concerned about that right now with the turn of the economy.
What about
Yeah.
I'm sorry, Craig. Are houses the same issue? What are we thinking about the correction that we might be seeing in the house sales on this chart here?
Yeah, we think that's going to be a little bit different in the housing market. We've had a lot of development and growth of equity into houses. The days that people stay in the house also has been growing as well, Zach. So we still have a supply issue, even with the elevated rates. There's no doubt that the higher interest rates on mortgages has decreased not only the refi market, but also some for the ability to actually buy houses because of the elevated cost of new housing. But we don't expect to have a big downturn on the actual house prices, just because there still is a lot of wealth that's been created out there. And we don't see much turnover in that industry, meaning people are opting to do the second mortgages, the home equities, and stay put and just continue to appreciate and maybe draw out a little bit of their equity that's grown over the years.
Which takes supply off the market, doesn't it? People staying in their homes.
Right. Takes supply off the market, not as many being developed, and they're therefore kind of keeping the prices elevated.
There you go. So just like the stock market, maybe a minor correction, not a massive correction.
Yeah, right on. Yeah,
very good.
Don't want to shy away.
And I think we wrap up the eco section with a little Fed talk.
Ooh, who doesn't like to talk about the Fed?
My wife. She hates when I bring this stuff up.
Does she really? Well, She's got many other wonderful attributes. Yeah, so looking back through recession and how the Fed reacts quickly, you can see back in 2020 when we had the pandemic, how they dropped so quickly, and now we're coming back up really fast as well. And it all is correlated to the inflation that we're experiencing. And there's no doubt that we've had, dare I use the word transitory inflation?
Are you allowed to say that word anymore?
I don't know.
I think it was banned.
It was banned, but I do know I purposely never looked up the definition of transitory.
Just like the Fed.
Right, exactly. It's been here a lot longer than they anticipated, and quite frankly, longer than I anticipated on inflation as well. But we are seeing that, and I do continue to expect inflation to continue to moderate and to see it slowly still be high and elevated, but coming down as not as big of an increase as we go forward. I do think the Fed is starting to impact a little bit. It's starting to impact different industries, as we can see. One of the things that I mentioned I'd talk about was some numbers that came out last week. The non-farm payrolls, they were positive. They were positive. Yes, way to go, team. But not as positive as prior months. We had unemployment rate ticked up 0.2%. Labor force participation. This is the one that I've been thinking about for the last several years, is we need that labor force participation rate to go up, and we're starting to see that go up. And we expect it to continue to rise, and I do expect going into the fourth quarter unemployment to continue to rise a little bit because of those two are correlated. But underemployment went up, as well as factory orders down and capital goods orders down. So we got a lot of signs of an economy slowing, and what the Fed is doing is starting to work as well. Is it too late? Is it too fast? Is it too slow? We can debate that all day long, but it's no two ways about it. We need to offset some of this inflation still. And that last chart is, this is the futures market for Fed funds. So people are making financial bets on where they feel Fed funds is going to be, and we capture this data. And right now we got the upper bound limit. It's 3 to 3.25, and you can see it kind of peaks out right now at 3.75 to 4%, which is only 75 basis points higher from where we're going to see it later on this month. Let me just pause for a moment, because it doesn't have our current. Our current right now is at 2.5% upper bound. So it's starting on the first Fed date coming up in 2 weeks. They expect them to raise interest rates 75 basis points to the 3.25. So we're looking at from a 2.5 to 4%, which is 150 basis points. The market is still expecting them to increase, and the expectations is 75 this month, another 50, and then another 25, all being done by December. So September, November, and December. And then the market feels that they'll be there for a little bit. There might be another bump in March of next year. I don't think that'll happen, but then they'll start to come down next year because of, hey, we've overcooked it a little. The economy's slowed down. Now we need to put a little bit more juice in it to get things continued along.
And Craig, I think this is a perfect segue, because, I hear often when we're about to get in the topic of the day here, I'll just actually show what we're talking about, the EBPA and the CDA accounts. Great transition, because when we think about interest rates and what the Fed's doing, if in fact we are reaching near a peak, and when the Fed hikes, if they do hike like the market expects, we're going to be fully inverted across the curve once we get around 4%. And so what that often shows us is we might be near, as you mentioned earlier, a peak of yields. And if yields come down a year from now, it's really signaling now is a really good time to put money to work. It's a really good time.
Right, locking in some rates. Go try to play as much as you can that duration game, getting some more duration on your books during this higher rate cycle. Absolutely, Zach, you said it very well.
Yeah, so let's dive right into it, because the main event, if you will, is the EBPA and the CDA accounts. Thank you, Craig. Really appreciate the tee up with the economy, by the way.
Yeah, you're welcome.
Yeah. So let's dive into this, have a little conversation. As Charlie mentioned, let's have questions come in. We're going to handle some at the end and maybe some during the presentation. So let's look at, I was thinking about this when we put this slide together, and this is kind of like the positive peer pressure slide, if you will. I heard peer pressure as an adult is when you see your neighbor mowing the lawn. You ever heard that one, Craig?
Oh yeah, I like to think about keeping up with the Joneses myself.
Yes, all my neighbors have that last name. So, but when we think about employee benefit plans and charitable donation accounts, a real good question is, if you're on this call, is who's actually doing these things? You know, I'm here to learn about it, but am I going to be the first one? Am I really late to the party? It's kind of in between, because what we see on this slide is employee benefit plans. About 35% of credit unions have some type of employee benefit plan, which, don't worry, we're going to explain what that is in a minute. The point is, though, is that these programs are for everybody. The asset size range is as little as $400,000 for an institution, all the way up to as big as it gets, right? $18 billion, really big. Credit unions are utilizing these too. Now, on the charitable donation side, that's what we call the CDA. 13% of credit unions have these. And we updated this number, if you've tuned into a prior presentation. This used to be 5%. Right now, 13% is still a small number, but this is almost 3 times what it was when we presented this report or this topic before. Huge growth.
Mm-hmm.
So it's really showing that the word's starting to get out there. Credit unions are starting to be aware that this is something that is going to benefit them. And a little spoiler alert, the CDA is my favorite account. It's not like kids. My kids are equal, but I like the CDA. It's just so much fun. And we're going to talk about how it really fits in with the credit union philosophy. EBPA is great too, but we're going to talk about why. All right. So speaking of the EBPA, the whole point of this account is the NCUA. So it originates from them. They allow a credit union to direct a portion of your excess liquidity into these investments for the particular purpose of offsetting benefit expenses. And you might be thinking, well, I can take excess liquidity and put it into any investment. What's the big deal? The point is that we're able to buy investments with a significantly higher yield and return expectation than we can in a standard portfolio. So it's a really great program. Let's look at how the EBPA works. We're not going to dive too deep into the regulation. We've talked about it before. We'd be happy to do one-on-one calls after this and really dive in. But the point is that you can invest up to 25% of your net worth. You can actually go a little bit bigger than that. This is a guidance number. It's not black and white, but it's a really good starting point. So let's take an example here. If we had a net worth of $40 million, and I'm kind of just projecting, thinking of a $400 million asset credit union, somewhere in the middle of, a little smaller end and a little bigger end. So if your net worth is 40 million and you have a 25% of that net worth, that is going to be $10 million. You can take that $10 million, and if we earn 6.5%, which is just a ballpark of where yields are on these type of investments today, what we're talking about is a return of $650,000. So do the math yourself. Maybe 25% of your net worth is 1 million. Okay, 65,000. What does that mean to your income? Maybe your net worth is twice this, whatever it is. This number is really a good indication of how much we can actually earn here. Now, let's use another example here. And what do we do with the actual earnings when we earn them? Well, the regulation is very clear. Anything that you earn on an EBPA, we've got to put it to cover expenses. But mentally, we can do a neat trick. We're basically making free earnings. And the reason is because you're going to be paying your employee expenses, whether you have an EBPA or not. You're going to pay them. So without an EBPA, we can look at a $10 million investment earning 3.5%. Approximately where the treasury is right now, so you can give and take with a little bit of spread there. But a $10 million account earning 3.5%, you'll be making $350,000. With an EBPA, if we take that same 10 million and we're able to increase our yield, you're making $650,000 with this example. So again, you're going to be paying expenses whether you're making 350 or 650. So the difference, we can mentally imagine that we're actually just increasing the bottom line by $300,000.
That's not a bad day.
It's better than a sharp stick, as they say, Craig.
Yeah.
It's a good thing. Yeah. All right. So we'll talk more about returns in a little bit, but what we're going to dive into now is the charitable donation account. I said it's my favorite. They're both good. The CDA is fun though, because the whole point of this is the NCUA allows you to take a portion of your excess liquidity and put it into an account, similar returns, but the earnings that we make are specifically to give to nonprofit charities. So what is your social mission? If you think about it, as a credit union, your whole purpose is to serve your community. You're going to serve them with good rates on loans, good rates on deposits as much as possible. That's a different conversation. But you're really there to serve the community. So what a CDA does is it allows you to focus on your social mission. And bullet point number 2 here, I think, is really nice. You don't have to do this, by the way, but we are hearing more and more of this developing. You can actually create a foundation in the name of your institution, so that when you're making money from a charitable donation account, you're actually paying the foundation, and it's kind of a launching pad where the foundation then can go into the community and give to whatever outcome that you're looking to give to. Craig, are you hearing more and more of that, foundations coming up? And I think you're on mute, sir.
Thank you. I am actually. It takes a few steps to actually go through and set up a foundation if you don't already have one, right? It's just there is some steps, but it really does streamline the whole process, because if you're actually just thinking about either giving away 51% or just giving away more, giving away all of the earnings out of it, you really can gift that to the foundation, and you're not under some kind of pressure to allocate to your social purposes at a time, and according to regulation. Then the foundation can actually really direct on a time and scale that they're comfortable with and have already put in place what their purpose is to support. It just really makes it so easy.
Yeah, absolutely. And what Craig's referring to there is there's regulation that requires the money that's made on this account to be given within a certain time frame, 5 years. But exactly, the foundation is almost like a cheat code. You put it to the foundation, satisfies the regulation, and you can take your time. And again, you don't have to have a foundation, but it's a really nice perk. So let's look at some of the dollars here. If we were to, let's say we started off with, how much money can we give? And then let's say we arrived at, we want to give $100,000. Maybe up to this point, we're giving $50,000, we want to double it. So what is it going to take to give $100,000 to charities? Well, without a CDA, these are kind of weird numbers, but it's how the math works out with today's yields. You would need about $2.8 million earning 3.5% to support that giving. Rough math. If you have a CDA though, and you're able to increase the earnings potential, you're not giving out of your standard investment portfolio earnings or lending earnings, you're giving out of a 6.5% return in this example. You're essentially able to have assets that are almost half the size. So right here we can see 1.6 million instead of 2.8, not exactly half, but about half the size. And essentially you're leveraging a smaller amount of assets to give the same amount of money. That's the whole point of this account, is to leverage the excess liquidity that you have. And I might hear some people saying I don't have excess liquidity. We're going to get back to that. So when we look at your giving being free, this is a neat way to look at this. And Craig already talked about 51%. So we're going to talk about that with real numbers here. What is 51%? Why did we mention that? Well, if you have $3 million in assets, back to the earning the 6.5 ballpark, you're going to make about $200,000. Well, the regulation reads for these accounts is that you're required to give away 51% of your earnings, so approximately $100,000. You're required to donate that to charities. But what that means is that the other half, the 49%, you're actually able to put that directly to your bottom line. So that's an awesome way to boost your earnings, essentially. And Craig, do you have to give away 51, or could you give more?
You
are you allowed to give more?
You are certainly allowed, and I'm a big proponent of actually giving away more, because ultimately it goes down to, why do we have a charitable donation account? And ultimately we have a social mission and a purpose, and we want to basically support the communities and members and purposes that we're here for, and who we serve, quite frankly. They have to be a 501c3 set up, legal organization. We just can't give away to anybody. But yeah, you can give all the way up to 100% of the earnings. Absolutely.
Absolutely. And a lot of people right now are giving up 100% of whatever money that they're setting aside. And this is just an opportunity to take that same amount of money and earn a little bit more. It's the whole point. And so here you go. Can you give more? Here's the answer. Absolutely. Like Craig said, if we took 3 million in assets, the same amount that we looked at before, and just put it all away, well, now we're donating $200,000. So we can either leverage a smaller amount of money, or lever a higher amount of money and literally just donate more.
Excellent. Just really quick, Zach, I apologize for interrupting you. This is the next page is perfect.
Sure.
And the reason I want to interrupt you is we do have a question out there, and this is actually a great time and segue for Let's Talking Returns. And the question out there is, do these accounts require the use of a professional asset manager to make investment decisions? And I want to talk about that briefly as you segue into this next section, because the answer to the question is no, you do not. You can do it on your own. You can use an asset manager. There's various ways of you can do it. But the one question, the answer to that is really important, though, and thinking about the answer to this is these are not traditional investments. They're investments that are otherwise impermissible, which by regulation, which means there is more risk involved in these types of investments. And if you don't have that skill set for managing those assets and understanding, monitoring them, doing the credit work on them, you have to be very, very careful. So whether you do it yourself or choose an asset manager that's reputable and understands all of the risks involved in these asset classes, then you're starting to do the proper due diligence before getting involved in one of these accounts.
And awesome point. And Craig, one of the things that I always hear from people when we get these accounts, when they choose to bring us in to help, is what do I need to do? And we're going to get into that at the end. But one of the things you want to do is notify regulators. And what they're going to ask you, step one is, do you have experience in this, or are you working with somebody who has experience, and do you understand your risk? So I think it's an excellent question. Absolutely. So thank you for the question, by the way. I didn't see who asked that, but really appreciate it, and keep them coming. But now we're going to get into some returns. And this is also a really fun part of the conversation. So step one is really, we need to talk about what are our goals and what is our risk tolerance. So here we say, it's kind of like choosing a retirement strategy. If you're 65, you're getting ready to retire, or 70, or whatever the age is, you're kind of looking at the next stage of no longer working. Well, you probably don't want to be an aggressive portfolio where the stock market might kind of give you some volatility, and now you're depending on that money. You might want to go more conservative. On the flip side, if you're fresh out of high school or getting into the job market and you've got 40 years ahead of you, or whatever it is, go aggressive. You got time. Let's make some money. And if you're somewhere in between, be balanced. Now, the analogy is not perfect because we're credit unions. We're not going into retirement, but it's very similar. If you're in a position where volatility is a massive concern, and we're going to get into that in a second, you don't want to be aggressive. Maybe conservative or balanced makes a little bit more sense. So a lot of words, this is actually pulled right from a report that we do. So don't worry, I'm going to tell you where to look, but this is pulled out from a sample portfolio where we're looking at a conservative approach to investing in either an EBPA or a CDA. So what we have here, and ignore the numbers too. The 5 million that we have, maybe you'd only be at 500,000 or maybe you'd be at 10 million. It doesn't matter. But what we have here with the 5 million and the 5 million, we have a total account size of $10 million. And what a conservative portfolio is doing is it's putting 50% into corporate bonds and 50% into preferred stocks. Most people are probably familiar with corporate bonds. You've got a maturity date, you've got a coupon. Less people I find are familiar with preferred stocks. It's very, very similar. There are nuances we won't dive into on this webinar. Be happy to answer them later. But essentially they act the same. There's a fixed dividend instead of a fixed coupon, and there's a maturity date. So why are these conservative? Because corporate bonds and preferred stocks, they tend to move when their values tend to fluctuate when it comes to interest rate movement, but they're not going to have the volatility that an equity market might have. So we're buying these investments. Obviously, there still is risk, even though it's a conservative portfolio. We're just mitigating some of that risk. And the gross yields that we're booking in this market for corporate bonds, anywhere from 5 to 7%. We're looking at Dick's Sporting Goods store, I think around 6%. There's an example of a bond that we bought recently around 6%. And then there's actually bonds that are yielding much higher than that and maybe a little bit lower depending on the credit quality. Now, we can look down here. The takeout yield is, for this client, about $500,000 on a $10 million account. Now, we always want to reference this to the actual net yield. 5% is really good. But we also want to look at the impact that this is going to have to your income. How much is this really going to impact you? For this client, we just assumed some numbers here, and it's good income. Let me put it that way. They're not making 15% ROE or anything crazy, but it's good income. This is going to boost their income by about 13%, which is significant. For you, maybe it's a little more, a little bit less. When we jump into the aggressive portfolio, you'll notice the percentages changed. We move from corporate bonds and preferred stocks into an equities position. And in equity, the biggest difference is the dividends are not guaranteed. A company can choose. Let's say they go through a bad year. If you've got a company that doesn't have a strong record of paying dividends, they could say, hey, we're not going to pay dividends right here on our stocks. They'll still pay it on the corporates, and the preferreds come before the common stocks, but they may choose not to do it. So there's a little more risk, but there's upside as well. So we can see that the return potential is now being added into this slide. Very conservative return potential that we're incorporating here. The market, if you go back in time, depending on the time frame, anywhere from 10, 12, even higher rates of return over a long period of time, we're going to cut that in half and just say, what if we get 6? It's better than nothing, but it's certainly not as high as it might be. But when we look at a return potential on equities, we are now increasing the actual overall return on the account. So even though the dividends are a little bit lower, we're showing here, than what the prior yields were, the return potential makes up for it. And now the increased income is looking like it's 20%. So as far as the increase of this client's income. So very strong yields. And we want to finish it off with a look at a balanced portfolio. Now, I want to make something clear right now. These are just templates. Nobody's going to fall, or typically nobody's going to fall in an exact template. We're going to really customize this if we work with you on this, right? We're going to customize it. But when we look at a balanced portfolio, the name is true. It's literally just balanced all the way down, 25% of each asset class. And the result is somewhere in the middle. We're having a net yield of around 6% is what we're modeling here, and a total increase to income of about 15%. So Craig, I'm about to move on to the other side of the table, which is risk. Before I do, anything to add on the return side?
The one thing which you actually did touch base on, and I just want to make sure I reiterate that, is when going through the due diligence of identifying the proper asset mix for your institution, meaning what risks you're comfortable with and how much. If there seems to be a spot where you have equities in there that says we can, we can tolerate some risk for a certain percentage of our portfolio, when you're looking at those equities, you really do you have to drill down and look at individual companies. If you're utilizing them, look at their dividend history, look at their credit history, look at their balance sheet history and trends of their income statement. It takes a lot of analysis, because you just don't want to go out and just pick a stock that, hey, this thing has great upside potential, but without anything other than that, so meaning the sector is hot. It's just very, very difficult. You want to be careful to make sure that you're managing individual risks within the portfolio in addition to that sector risk.
Absolutely. And what that brings to mind, actually, which is right along with risk, is a beta. We're going to talk a little bit about a beta as it relates to the stock market. But here we go. Craig, do you recognize this image?
Is that the game of risk?
This brings me back to every Christmas I ever had as a child. So I had to put it out here. The game of risk. So we're going to make risk fun. It's a fun game, right? Risk for the EBPA and CDA, not quite as fun, but we want to make we want to enjoy it as much as we can. So let's go right into it. We're going to look at a conservative portfolio, and what does risk mean? What do we actually mean when we talk about risk? Well, one is a risk to income, right? So we have a starting point that we already talked about, the amount of money that we might make on this account based on some hypotheticals. And what we did was we put it through a couple of scenarios. What happens if we get a little bit of a pullback in the stock market, or a correction, or even a bear market? And let's just highlight the bear market here. This is, we're modeling a 20% decline in the stock market. So it's a lot more than it sounds like, because the stock market's already moving. So now we're really moving. And we have this corresponds to 300 basis points movement up in interest rates, which is everybody's favorite ALM metric. So we might as well throw that in there. So what's the impact to income? We can see it doesn't matter. When we're in a conservative portfolio, it literally doesn't matter. And this should ring true for those of you that have standard investment portfolios. You may be looking at unrealized losses because of interest rates moving. You're making the same amount of yield. It's not impacting that situation. What about the adjustment to capital? Capital is strong and it's not going to be affected. Even if the portfolio value goes down, none of these assets in a conservative portfolio are going to affect your capital, and therefore they're not going to affect your net worth ratio either. Now, when we go into a balanced portfolio, this changes slightly. We can see that the income stays the same. It doesn't matter what the market's doing, your income's going to be the same. But why is the return up here a little bit different than it is down here? Well, you're losing the capital appreciation of the stock element, right? If stock market's down, you're obviously not making that upside. So now we're introducing that risk. In anything that is an equity, or anything like an equity that doesn't have a maturity date, when those values fluctuate, that affects your income. If it goes up, you made money on paper, but you still made money. And if it goes down, it runs through your income statement too, and you lost money, even if it's only on paper. So that affects the portfolio. We can see the portfolio value changes. It also affects your net worth, which these are very important things. People often ask me, what should I do? Should I do a balanced portfolio? Should I do conservative, aggressive? I want to make as much money as we can. Well, it really depends on your starting point. If you've got a very strong net worth ratio like this credit union does, maybe balanced or aggressive might make sense. If you're starting with a little bit of a lower net worth, and the fluctuations of these values will bring you even lower to a place where you're not going to be comfortable, do not do that. It's not worth it. Stay conservative, where we can look at these will literally not be impacted at all.
Zach, there is another question out there. I'd like to pause if that's an okay time for right now.
Oh, please. Yes,
Sure.
Let's hear it.
All right, there's another question out there. It says, the question is these estimated performance metrics are helpful.
Hmm.
What has been the actual performance experience over the past 12 months for credit unions holding these accounts, and how has that impacted their earnings? It's actually an excellent question, because as we look at these accounts across various clients, we don't have one client that has the exact same cookie cutter portfolio as another. I kind of look at it and compare it to a mutual fund. Whereas a mutual fund, everybody's going to be experiencing the same returns as the other person, regardless of how much money they have put in there. And the change in their value of their account is relative to their earnings. Whereas our accounts here that we utilize are all what we call a separately managed accounts, portfolios constructed specifically for each client. We have clients that are very conservative with just corporate bonds and non-mark-to-market preferred stocks, which are not perpetual. And then we have some that have a mix of perpetual preferreds and some equities. So the performance has been very different across the whole board. But I can also say, and Zach, correct me if I'm wrong or shed a little bit more light, is the more balanced, or the ones that have some equity exposure, the fixed income preferred returns have been elevated. And we look at those from a total return standpoint over time. And the equity market devaluation hasn't been huge, because we don't have anybody that's gone in 100% equities for their portfolio when looking at these types of portfolios.
Yeah, we do have some portfolios that are a little more aggressive than others, and a lot of it has to do with timing. I mean, this is a really important thing too. It's if you know, you look at the stock market, it's been up, it's been down, and we're going to get into strategy and averaging in, right? But when you look at where the stock market's down, if you've been buying for the last couple of years, you're still up. So a lot of it's starting point as well, but we can minimize those movements by reducing the amount that's allocated there, or by actually just taking our time actually getting in. And we're going to talk a little bit more about that in the future.
Yeah.
Yeah.
Thank you. Thank you. Sorry about the interruption there.
No, absolutely. But a little more, maybe the spirit of the question too, is if you're going to get in right now, if you're not in, yields are very high, very strong right now. So these are pretty close to what we're seeing in the market right now, around, again, 5, 6, 7% for fixed income. All right, a little more on risk. And I'll fly through this page. We have corporates, preferreds, and equities. That's the direction that they go as far as increasing risk. Obviously, cash is no risk there, except you're not going to make much money. Oftentimes, there's a risk. But when we look at equity, I just want to highlight something. We have a bear market. I already told you it was 20% decline. Why are the equities only down 15%? Well, it's because we're using a metric called a beta. And a beta is simply this, and you're probably very familiar if you're familiar with your ALM side, right? If the market moves a certain percentage, you're only going to move your loan rates or your deposit rates a certain percentage of that. Same concept. If a stock has a low beta, let's say 50.5, and the stock market moves this much, well, we're only going to move half that much on average. If you have a high beta and the stock market moves this much, hopefully you can see me, we're going to move maybe a little bit more. So we favor low beta stocks. We're not trying to hit home runs. We're trying to make a strong income and a reasonable return over a long period of time. So we favor low beta, so that when we do have the declines and the bear markets inevitably come, we're going to participate in that less. We'll have less participation in the downside. Does that make sense, Craig? Anything to add to that?
Yeah, well said. And it kind of goes down to, we're not randomly picking a stock for its just dividend yield as well. You have to be very deliberate. And it kind of goes back to that asset manager question is if you're going to get into this, you want to use somebody that knows the product, knows what they're doing, knows the regulation, and is really giving you a deliverable product that's really created for you.
Right. Have a reason for what you're doing and have a process is absolutely key.
Yeah, right.
I'm going to actually skip through this next page just for sake of time. And let's wrap things up. Here's another fun one. Craig will ask you this one too. Do you recognize the picture on the screen here?
My favorite is cherry.
Okay. I don't eat these because they would literally rip my teeth out, but I used to love them. It shows you I'm getting old if you can see the gray coming in. But we got now and later. What are we talking about? Now is better than later. It's very easy to say, I'll get to it, but now is better than later. And let's talk about why. So I thought this would be fun to put this up here, because I have these conversations every week, multiple times a week, and I want to kind of eliminate some perceived obstacles that you might be thinking. Maybe up to this point, you're thinking, I would, but. Well, these are some of the buts, and then we're going to talk about why they might not be. So on the left-hand side, we can see liquidity. I don't have liquidity. Maybe market timing. I think the Fed's going to raise rates. The market's going to go down. There's all these different thoughts. The third one's my favorite, my time, meaning your time. You don't have time. I get it. I really do. Next year, we'll do it next year. Am I missing any, Craig? That's a good summation, isn't it? Of
No,
obstacles.
it's a great summation of perceived obstacles. You know, and if you threw in the last one, it would be just risk. And
Sure.
so then, you know, risk is the other one which you've covered, and things can be structured to avoid the risks that one is concerned about. If they're worried about market changes, well, then we don't put equities into that portfolio, right? Yeah.
Absolutely. We could, even think about education. I don't know, have enough education. There's certainly more, but these are the ones that I hear often. And so let's address some of them. If you don't have liquidity, this is maybe a unique concept, or maybe not for those of you on the call. We can do a swap analysis, right? You can take a look at the investments that you do have already in your standard portfolio. What if you sold them? Probably going to take a loss. You're going to give up a little bit of income. But then we can look at, if we reinvest at a much higher return, we're going to recoup that loss and more than replace that income. And if that loss recuperation is on a short enough period, right? If you're able to make your money back in 6 months or whatever the time frame is, 12 months, that is going to be net profitable for you. So generating liquidity can actually be a strong option, or just waiting for investments to roll off. And using that instead of putting it back in a standard portfolio. Let's talk about market timing. If you think the market's going down, you might be right. If you think it's going up, you might be right. And but I tell you what, if it's going down, that seems riskier. But we can be in a position where we're actually, it sounds weird or maybe even bad, but we might be rooting for the market to come down in a sense. For at least new purchases, we're saying, hey, we're going to get a better price. You're able to average down if that happens. The other side of it is, you might say, well, that sounds great, but it's not for me. Okay. We can literally just avoid the market altogether. No problem with that. My time, we're here to help, right? It's why we're doing this. We want to educate. We want to show you how we might fit into the solution as a part of these programs that the NCUA created. And we'll do the heavy lifting, which we'll get into more on the next page. What about next year? The way I think about this is opportunity cost. We've got a quarter left. Let's make some money. I know budget season's right around the corner. Let's make some money, get a track record under our belt, and now we'll be able to forecast what we might be able to make going into 2023. We'll put it in the budget. Now we're going to increase income and maybe do some more fun things around the credit union.
Yeah, I know we're pressed for time, and I just wanted to add one thing. When you look at that liquidity hurdle type thing, is along with that swap analysis, is people are looking at incremental benefit of borrowing when they have a liquidity problem versus booking loans right now. And this can be done the same way as well. Incremental benefit of what does it cost to get your next dollar in the door so you can do something with it versus what the return on that asset is. So, and you can see, it's like, especially in a conservative portfolio, when you're hitting 6%, yeah, it's the food for thought there. So go on.
Absolutely. No, that's great. Liquidity is such a huge conversation right now.
Got about a minute left here, Zach.
Yeah, we'll wrap it up this in a minute then. So here, let's start the process. This is how this works. Understand the programs. That's the whole point of this webinar. There's a lot more to understand. We'd be happy to help. Notify regulators of your intent. If this is a path you're walking down, let them know as a courtesy. Not required, by the way, but really appreciated. We need to talk about goals and risk. What's an appropriate portfolio size? Develop a policy. That's something where we can do the heavy lifting with you. We have policies that we can help you create. and then approve that policy. And that's the board's responsibility. Also making sure they're educated. Again, something we'd be happy to help with. And then finally, open the account and just invest. That's the whole point, right? We want to get the money moving. So I'll end with this bullet on the bottom of the statement on the bottom. These are created and approved by the NCUA. I know it might sound a little bit out of left field. I've never heard of these before. I don't know, I'm not sure. The NCUA literally created it. They know your expenses are high. They know you want to give to your membership in your area. These programs are designed to do it, and we'd love to partner with you on it or help you in any way that we can. I'll end there. Charlie, want to take it from here, sir?
Yeah, thank you, Zach. Thank you, Craig. Really appreciate your time and expertise. You guys are truly incredible at this and have a vast amount of knowledge, and I love sitting here and listening. I learn something new myself every time. So again, thank you very much. You guys have any questions out there? I know we're running out of time. There's a few questions that are coming in. We'll respond to each of those individually. So thank you all very much. Coming up next, our next webinar is on September 22nd, 2 p.m. Eastern Time. We're kicking off the budgeting year, as I heard a moment ago, industry update for planning and budgeting. So join us, our annual activity where we prognosticate what's going to happen over the next remainder of this year and calendar year as everyone gets ready for the budgeting activities. So with that, thank you all very much. I appreciate the time. Have a wonderful rest of your day.
Have a good day, everybody.
Thank you. Bye-bye.